Forex hedge trading strategies. The word hedge abbreviates a way of protecting oneself against financial loss or other adverse circumstances. Forex hedging is a method which involves opening new positions in the market in order to reduce risk exposure to currency movements. Basically, hedging is a financial strategy that should be understood and used by investors because of the advantages it offers. As an investment, it protects an individual's finances from being exposed to a risky situation that may lead to loss of value. However, hedging doesn't necessarily mean that the investments won't lose value at all. Rather, in the event that happens, the losses will be mitigated by gains in another investment. Hedging strategies in Forex. There are three main strategies of hedging strategies: Forex correlation hedging strategy, Forex options hedging strategy, direct Forex hedging strategy. Forex correlation hedging strategy. It's one of the popular hedging strategies to trade Forex. It involves the use of highly positively or negatively correlated currency pairs. The GBP US dollar and GBP Japanese yen is just one example of this. In fact, in likely cases, the degree of the positive correlation between those pairs is above 90%. This essentially means that those two pairs move in the same direction for at least 90% of the time. This hedging strategy for Forex traders is also helpful in the sense that the market participants can utilize not only positively but also negatively correlated pairs as well. One example of this would be the Australian dollar against the US dollar and the US dollar against the Canadian dollar. Forex options hedging strategy. It's optional for those traders who don't like to open several positions for hedging in Forex. There is another way, the use of options. Forex option hedging strategy gives them a right, but not an obligation, to buy or sell currency at a predetermined rate, at or before a specific date in the future. Let me define. Let's suppose that a trader has conducted a thorough analysis of the Australian dollar-New Zealand dollar pair and concluded that it would be better to open a long Australian dollar-New Zealand dollar position at 1.05 level. So far, everything's quite straightforward. If the Australian dollar appreciates against the American dollar, say to $1.07 level, then an individual can have a winning trade and also earn some nice payouts in the process. Direct Forex hedging strategy. Direct hedging strategy in Forex is open both buy and sell position in the same currency pair. However, this method has two unexpected dangers. Firstly, after the Great Recession in 2009, the US Commodity Futures Trading Commission issued a new regulation and banned this practice. For example, according to those new rules, if a trader has opened a long Euro-US dollar position and then tried to open a short position with the same pair, the broker is compelled to close the first trade. The reasoning behind this is that CFTC believes that traders are always at a loss when using this method. On the other way, this is legal method for trader to trade on Forex.